I am the Global Director of Automotive Research for Bloomberg Intelligence. So although this presentation is really about the auto industry, which has been disrupted, obviously, coming on about 10 years now when Tesla introduced Model S, I think the lessons that we're seeing now are relevant for other industries, even if you don't care about the auto space, and I'm not offended if you don't. And I remind you that on your badge you have the Q&A code. I'm probably not going to get to your questions, but I did get one that was kind of interesting, and I think it underpins my point here. And the question that came in is almost like I wrote it myself, but I didn't. One company that you expect to be the leader in disrupting the EV space, which is interesting, and remind me that I left it there. I don't want to leave my stuff behind. So the industry has already been disrupted, and if I'm reading the question right, it's an interesting point that the disruptors are due for disruption. And I'll walk through who I think that's going to be. So I didn't really intend to answer that question. I'm not going to pick stocks up here, but we'll get to some of that. So Bloomberg Intelligence is basically a sell-side firm within Bloomberg. We're not reporters, we're not journalists, we are actual analysts. I came from the sell side for a dozen years, top stock picker for automotive and automotive parts, and was there at the beginning of Bloomberg Intelligence, which was originally called Bloomberg Industries back in 2009. All right, so let's get into it. So Tesla, so this is the market cap chart for Tesla, and even though it looks like, can I get my thing in one of these instead of time in both? Sorry. Just so I don't have to keep turning around. So if you look here, right, it looks like Tesla went crazy at the beginning of the pandemic, which is like January 2020. But that blue line is actually General Motors. And also another housekeeping point. If the slides, some of them are busy, but really don't worry so much about them. And if you want the slide deck, I can send it to you after. Just see me hanging around here and just give me a business card. I'll send you the presentation. So if you look, Tesla's valuation surpassed General Motors somewhere around 2017. It's back, let's see, we'll use the laser, somewhere around 2017. So think about that. And at the time, Tesla produced and sold globally 100,000 vehicles, and General Motors sold 9.6 million vehicles, yet surpassed it in valuation, right? And obviously, let me just go back, and obviously we see what's happened since November of 21, which is the same thing that happened to Lucid. That valuation got up, above $90 million. General Motors would typically be in the $40 and $50 million range. So you have Lucid with a market cap almost double as General Motors, 6,000 units this year, right? So this was well, they had put out forecasts that were much higher than 6,000. They've reduced those. Right, so you have a company producing 6,000 units globally. That's double the valuation of General Motors. And Brett talked about Rivian. I would imagine you'll see that caddy on the golf course next summer. Probably not retired, especially if they bought it. Well, unless they got out right away at the spike. But a $150 billion company this year, they're going to do maybe 25,000 units. So we get these crazy valuations, and maybe I shouldn't call them crazy, maybe they're justified, of EV companies, I don't know, ESG, technology companies, whatever you want to call them. But look, here's the group since November of last year, right? And those guys in green are the pure play EV companies, right? So we've seen some pretty dramatic declines in the market cap of those companies, which goes back to that original point. Like, is it time, right? All those three charts tell me, might tell you something different. They tell me, like, we missed it, right? That peak, which was November of last year, is probably over, right? So these companies starting to be disrupted. Now, let me just make a quick point on adoption and the government role in this, because I get this a lot, There'll be more charging points, and there'll be the Inflation Reduction Act, which will drive adoption of EVs in this country. And you can see we're the white line in this country. We're just about 6%. battery electric. This doesn't include hybrids. This doesn't include plug-in hybrids. This is pure battery electrics. So we're behind Europe and China. And here's why, right? And don't worry so much about this slide. That red line is kind of what's important. But that is what BYD got from the government, the Chinese government, as the government wanted to push EV adoption. That is $44,000 per vehicle, right? So BYD is producing EVs in China. They're losing money on them. Government says, no problem. We'll make you more than whole. So over that time, call it 2013 or so, $1.3 billion to one company in direct subsidies from the government. And that number now is about $15,000 per unit. So not so worried about that. But so let's talk about what the U.S. government is doing with the Inflation Reduction Act. And really, to lay the scenario out, we give federal tax credit if the consumer even knows what that is and has a federal tax credit. It's 1 year, there's no carry forward, and it only offsets your federal tax bill. We have the government investing trillions in infrastructure. But if I'm an automaker losing $10,000 to $15,000 per EV, what do? Well, I just don't make them, right? So you can have your federal tax credit, government can invest in infrastructure, but as an automaker, if I'm losing money, I just don't make them. And that's why we're 6% here. We're not 6% here because we can't figure out, automakers can't figure out what Tesla does. Tesla has some magic formula. There are competitive advantages, some legitimate, some the fact that they can lose money year over year and still raise capital for free is one of them. But ultimately, the IRA will get interesting, I think, in 2024 when the tax credit, and I have to do a little bit more research on this, but the tax credit might turn into a tax rebate at the point of sale. Very important, and here's why. Because if you're going to, as a buyer of an EV, if you can find one you like, you will get $7,500 federal tax rebate right there. The credit, you don't even know if you're eligible until you file your taxes the next year. So what happens is that you get your $7,500 at the point of sale. The government says to the automaker, hey, why don't you raise your price by $7,500, and we'll just basically pass that money from the consumer right off to you. Which is what happens basically in China. So conveniently, you start to see, as the IRA was being discussed and passed and all laid out, you get automakers raising prices conveniently by $6,000 to $8,500, right in the range of what a federal tax rebate would look like. So essentially what we have now, and honestly, this is the right way to do it. We have the government, for lack of a better term, laundering money through the consumer to the manufacturer to make them whole or closer to whole on EV, money-losing EVs. We haven't had uncompetitive EVs in this country because we can't figure out a good EV. We've had uncompetitive EVs in this country because they're unprofitable. Okay. So blame it on supply costs, blame it on chips, whatever you want. The fact of the matter is, until they're making money on it, we're not going to get a full effort on EV. So here's the other thing. We'll do this. We were talking about it last night. Some misconceptions in the EV thing is that EVs, Tesla has better gross margins than everybody, and they direct the analyst's eye to two things, gross margin and deliveries, which they push deliveries at the end of the quarter, and they always talk about their gross margins. And this has nothing to do with the regulatory credit sales that they get, which are essentially cost-free. So what we know about EVs, right? Simple to manufacture, the factory's totally automated, fewer moving parts. So you would think that the EV makers have the top gross margins. So you would think that that would be Tesla, Lucid, Rivian at the top there. It's actually not. And it's hard to see. I get it. But that's Ferrari. They have more creative accounting. So their R&D expense is below the gross line. Everybody else, R&D expense is in their cost of goods sold. So all the new disruptors basically take that expense, they put it in the operating line and say, look at our gross margins. So actually that's Tesla in the mix of global automakers at the gross margin line. That's the other pure play, and there's NIO. I don't have Rivian and Lucid on this chart because that's their gross margin profile forward, right? So they're not even on like they don't make the list because they're still negative. And the amber lines are actuals. The other two sort of grayed out lines are forward-looking. So we have 2 more years of unprofitable EVs at the gross line before we start to even think about these companies being competitive profitability-wise. All right, so the other misconception, right? Fewer moving parts, easier on raw materials, but the fact of the matter is, and these are all the things that go into an automobile, that's actually electric vehicles. That's the batteries and the materials that go into an EV, 6 times what an internal combustion vehicle would be, right? So we a lot in ESG, and don't get me started, we look at, and I say we, the media, investors, analysts, one small part of the process, the tailpipe, or that there's no tailpipe, but we don't look at, some people will go well to wheels and say, well, how are you generating the electricity to power an EV? And I'm saying, let's talk about how we're mining the materials that go into the EV in the first place. And then let's take that all the way to the end of life and talk about what we're doing with batteries after. Nobody talks about that, and I think we're starting to, hopefully. I think it's a more legitimate and transparent discussion. So who controls those materials? And I know this is impossible to see, but what you need to know is those red lines are China. So all those materials that go into the EVs, this didn't just happen. This is decades of actually positioning themselves to control the materials in terms of EVs. So the idea that battery costs come down, or maybe there's some technological breakthrough that makes some other use that we can be competitive. But right now, this is where we're going to get materials. So here's an example. Lithium carbonate, cost per vehicle. Lithium carbonate is the raw material that goes into the battery. None of the other stuff, just the raw material. So back, way back at the beginning of COVID in 2020, for a 60 kilowatt battery, which is small, we were talking about $10 per kilogram USD. Now it's, as you can see, it's up close to 80. So the input of that raw material back just not even 3 years ago was $660 into the battery. Today it's $4,700, right? So there goes, and then you get, I didn't have it on here. Let me just come back if I can. So then you get Ford saying, hey, Mustang Mach-E was profitable around $50,000. Now at $60,000, it's probably break even. Right? So if I'm an automaker and I can sell pickup trucks all day long profitably, 5 figures per each, but I got to break even on $60,000 vehicles, that's not such a great push. Then they control supply. There's a recall, can't sell them. So coming back to the first question, my point is there's the disruption of disruptors will probably be the legacy automakers. So here's that 6% is all pure play EVs, right? It really hasn't been contribution from the legacy automakers. So if you look here, and at the peak it's above 85%, the contribution in the US of the pure play EV makers, almost all of it is Tesla, right? Rivian and Lucid just came on the scene. The legacy guys, Mustang Mach-E, a couple of F-150 Lightning, Chevrolet Bolt, were a little bit in that. So here's our EV penetration, and it's really kind of picked up. But even still, that's 6%. And so here's the point, that this is controlled by the automakers. This is orchestrated by the automakers. That amber line is truck adoption, and that would include pickups, SUVs, crossovers, minivans, what have you. So in the time it took us to go from 0% battery electric vehicles to 6%, we've gone from 50% truck to 80% truck. And that number, and we will have electric pickup trucks and SUVs and whatnot. So that number will go higher. But it's interesting to me, and I always make the point that we think like consumers, right? The consumer's driving this. We want EVs, we want EVs. The automaker's not making them, and trucks are making them profit. This is what we get, right? At a time where we talk about EVs being the future, I'm sorry? Okay. Being the future, we're buying more trucks than ever, right? We were talking about this at dinner last night, right? And I'll get to it right here. So here's the mix, truck versus car. So the idea that we can go back to cars, they just don't exist anymore, right? We're 80%, we're going to 85, we'll probably go to 90. Ford, GM, and Stellantis' Chrysler brands are already well into the upper 90s. Ford's like 98% truck. There's one car left, Mustang, which is actually their best seller. General Motors' best-selling car in all of General Motors is Corvette, which averages $82,000. Right? So there's nothing left to buy. There's no well, there is a Malibu, but they don't sell a lot of it. But there's no Focus, Fusion, Fiesta, Taurus, you name it, right? So as you look at this, right, and we'll talk about profitability a little bit, the legacy automakers really have the potential. So in the time that, and this is a cumulative pre-tax income number, and it'll include Tesla's federal tax credits, which regulatory credit sales, which is fine. It's part of doing business. So you can see that they just turned profitable at the end of 2021, cumulatively, and that number's like 11%, 11 billion. In that time that took Tesla to get to 11 billion, Toyota earned $250 billion, right? So my point is, the automakers will get to EV when it's profitable to do so. Largest segment in the US, full-size pickup trucks, right? Yeah, sure, we need them, two bags of mulch every season in the back. But it's not an accident, it's orchestrated, right? This is what's profitable for automakers. This is what they can make profitably. This is what is marketed, it's designed, it's manufactured, and this is what we get. And we're told that that's what we need, and it's rugged. And when EV is profitable, that it could be that segment, right? So here's midsize and compact car volume for GM and Ford, right? It goes to zero, and EV takes up the slack in terms of emissions and fuel economy goals. And here's the interesting point, what that mix shift in the US does, moving to trucks, and why automakers are orchestrating it. We're actually selling more $50,000 vehicles today than we did $40,000 vehicles in 2019. Not 10 years ago, just before the pandemic. So automakers have gotten out of the cheap cars, they've gone to the big trucks because it's where the money is. So when the time comes where EV is profitable, this is who are going to be the disruptors, the big, large automakers. Lithium carbonate, did we do that? So ultimately, that's my point about commodity costs wiping out profitability. Let me just scoot through there. So ultimately, those market caps, exorbitant market caps of EV companies are ready to be disrupted. The companies that are going to do it, and I know it's very maybe unpopular or unsexy to say, it's going to be the legacy guys. It's going to be the Toyotas, the company, General Motors, Ford, companies that have global scale of automotive manufacturing, distribution, after sales already in place. The change becomes, now we just need to make those drivetrains, right? So that's my time. Come see me after. I got my book. And if you want the slide deck. Thank you very much.